Peyto Exploration and Development Corp, PEY, is distinguished within the highly cyclical Canadian energy sector by its integrated operating model, exclusive focus on the natural gas-rich Alberta Deep Basin, and structural cost efficiency. This report confirms that PEY has successfully navigated the complexities of its recent acquisition integration and the sustained volatility inherent in Canadian commodity pricing throughout 2025. This successful navigation is evidenced by a critical restoration of the company's capital discipline and self-funding capacity. The central investment thesis for Peyto hinges on its unparalleled operational effectiveness, which generates robust and predictable funds from operations, FFO. This cash flow is further stabilized by a disciplined hedging program, which insulates financial performance from short-term commodity price weakness. The company's financial momentum is clearly demonstrated by a 26% year-over-year increase in funds from operations during the third quarter of 2025 and the significant progress made in de-risking its financial structure. Key financial conclusions. Income and margins. Earnings quality remains high. Third quarter 2025 earnings surged 78% year-over-year to $90.7 million, underpinned by an impressive 72% operating margin. This performance is structurally protected by PE's hedging strategy, which has proactively secured approximately $655 million in revenue for 2026, providing a critical buffer against potentially softer industry macro forecasts for the upcoming year. Cash flow and capital discipline. The total payout ratio, TPR, a key non-GAAP metric measuring the funding of capital expenditure, decommissioning obligations, and dividends against FFO, improved decisively from 125% in Q3 2024 to 99% in Q3 2025. A TPR below 100% signifies that Peyto's internal growth requirements and all current shareholder returns are fully funded by operational cash flow, validating management's long-stated strategy of maintaining financial balance. Balance sheet health. While the company successfully reduced net debt by over $105 million in the first half of 2025, reaching $1.24 billion by Q2 2025, a critical liquidity consideration has emerged. The current portion of long-term debt saw a sharp increase to nearly $150 million in Q3 2025. The effective management and amortization of this material near-term maturity will be paramount for continued balance sheet deleveraging into 2026. Valuation. Peyto appears moderately undervalued on a trailing earnings basis, trading at a price-to-earnings ratio, PE, of 12.10 times, which is a notable discount to the Canadian oil and gas industry average of 14.7 times. The company's established structural advantages, including its industry-leading low costs and exceptional reserve longevity with a 10-year proven developed producing reserve life index, support a fundamental argument for a PE re-rating closer to, if not exceeding, the industry benchmark. Peyto offers defensive positioning and stable income supported by proactive financial and operational management. The company is positioned as an attractive value proposition poised for multiple expansion as its debt metrics improve and its capital model demonstrates sustained self-sufficiency. Analysis of income statement performance and revenue quality. Peyto's income statement in 2025 provides compelling evidence of successful execution in a challenging commodity environment, reinforcing its reputation as a low-cost, high-margin producer. A. Q3 2025 results and earnings quality. The financial results for the third quarter of 2025 showcased substantial operational and financial leverage. Peyto reported consolidated earnings of $90.736 million, translating directly to $0.45 per diluted share. This performance represents a robust year-over-year growth rate, reflecting an increase of 78% compared to the $51.029 million reported in the third quarter of 2024. The 9-month cumulative performance further highlights this strong trend, with earnings reaching $292.685 million for the period ended September 30, 2025, significantly up from $202.341 million in the comparable period of 2024. This substantial earnings acceleration was fundamentally driven by an 8% increase in production volumes, which averaged 129,762 barrels of oil equivalent per day. The successful integration of acquired assets and sustained capital efficiency allowed Peyto to capitalize on prevailing prices. Despite the strong underlying operational metrics, the reported earnings per share of 0.45 fell marginally short of the analyst consensus forecast of 0.47. 1. However, the market's reaction to the announcement was strongly positive, with the stock rising by 5.05% in after-hours trading. This disconnect suggests that market participants are focusing more intensely on non-GAAP metrics like the 26% year-over-year growth in funds from operations. For an E&P company, FFO is often regarded as a superior measure of financial health and intrinsic value creation, as it discounts non-cash items such as deferred tax or depreciation that can obscure true cash-generating ability. The positive investor sentiment therefore indicates confidence in the core operational efficiency of the company despite minor fluctuations in reported GAAP earnings. Margin analysis and structural cost efficiency. Peyto's ability to generate superior margins is rooted in its highly efficient and integrated cost structure. The Q3 2025 results confirmed a high level of profitability, reporting an operating margin of 72% and a profit margin of 29%. Maintaining such high margins in a volatile natural gas environment is a testament to the company's structural competitive advantage. This advantage is most clearly observed in the company's operating expenses. In Q2 2025, total cash costs were reported at an industry-leading low of $1.31 per 1,000 cubic feet equivalent. The cost profile breaks down into remarkably low rates. Royalties accounted for $0.14 per MCFE, operating expense was $0.54 per MCFE, transportation stood at $0.31 per MCFE, general and administrative (G&A) was $0.06 per MCFE, and interest expense was $0.26 per MCFE. This low-cost structure provides a substantial cushion against price decreases, particularly as PEY benefits from cheaper access to the NGTL and Alliance pipeline networks, circumventing the greater congestion and higher costs faced by producers further north in the Montney region. The long-term efficacy of this strategy is validated by the company's historical performance metrics. Over the past 26 years, Peyto has achieved a strong average return on capital employed, ROCE, of 14% and a return on equity, ROE, of 24%. While more recent quarterly figures, such as a Q2 2025 ROCE of 10% and ROE of 12%, reflect the dilutive effect of the increased capital base resulting from the 2023 corporate acquisition, the company's core cost structure remains superior, suggesting that returns should trend upward as the acquired assets are further optimized and debt is retired. Strategic hedging for revenue stability. A crucial element supporting the quality and predictability of Peyto's revenue stream is its highly disciplined and proactive hedging program. This strategy is essential for an E&P company operating primarily in the natural gas market, providing necessary protection against rapid price declines. The program delivered significant value in the first half of 2025, with realized hedging gains of $50.8 million in Q1 and $52.6 million in Q2. Extending this proactive management into the forecast period, Peyto has successfully secured substantial revenue for 2026. The company currently holds a hedge position protecting approximately 410 MMCF of natural gas production, locking in an average price of around $4 per MCF. This translates to approximately $655 million in secured revenue for the upcoming year. The extensive hedging of 2026 production volumes provides profound and measurable financial stability. Independent macro forecasts for 2026 suggest potential weakness in the broader North American energy market, with some analysts projecting lower West Texas Intermediate oil prices and generally conservative outlooks for Canadian E&P capital spending. By proactively securing a material portion of its production at favorable prices, Peyto ensures a resilient baseline for its funds from operations, effectively guaranteeing the continued funding of both its capital program and the dividend, irrespective of near-term cyclical volatility. This strategy de-risks the company's capital deployment plan and strengthens its financial foundation for long-term growth. Cash flow dynamics and capital funding efficiency. The cash flow statement analysis for Peyto highlights its robust capacity for cash generation, which is central to the company's valuation thesis. The company's consistent conversion of operational efficiency into strong cash flow demonstrates a decisive shift towards capital self-sufficiency following the 2023 acquisition. Funds from operations growth trajectory. Funds from operations, FFO, serves as the primary metric for measuring the company's ability to generate cash flow from its core productive assets. In Q3 2025, Peyto reported FFO of $198.9 million, marking a significant 26% increase year-over-year. This performance corresponded to $0.98 per diluted share.
This Q3 result reinforces the strong trend established earlier in the year, with FFO reaching $225.2 million, $1.12 per diluted share in Q1 2025, and $191.3 million, $0.95 per diluted share in Q2 2025. The consistency and growth in FFO generation provide the foundational capacity required for simultaneous debt servicing, investment in the asset base, and the distribution of shareholder returns. Free funds flow, FFF, generation and coverage. Free funds flow, FFF, is the discretionary cash flow remaining after accounting for FFO and all essential capital expenditures required to maintain and grow the resource base. This metric directly reflects the capital available for non-essential uses such as debt reduction, share buybacks, or dividend payments beyond the maintenance level. In Q3 2025, Peyto generated $69.1 million of FFF. This FFF figure is derived after accounting for total capital expenditures of $126.3 million and decommissioning expenditures of $3.45 million during the quarter. The company's management model mandates the balancing of its capital program and dividends with available cash flow. A direct comparison of the FFF generated against the shareholder distributions reveals a crucial finding. The $69.1 million in FFF comfortably exceeded the $66.4 million distributed as dividends in Q3 2025. This positive surplus provides a powerful confirmation of dividend sustainability. It demonstrates that the current monthly distribution rate of 0.11 cents per share is fully funded by cash flow that remains after all operational and organic growth capital needs have been satisfied. The successful maintenance of this FFF surplus is essential for Peyto to continue its stated strategy of reducing leverage. Capital program discipline. Peyto's capital allocation strategy remains focused and efficient, leveraging its unique deep basin positioning. The company's capital spending, exemplified by the $126.3 million expenditure in Q3 2025, is directed toward high-return projects primarily involving extended reach horizontal (ERH), which optimize resource capture within its substantial 1.1 million net acres of deep basin lands. Management demonstrated flexibility and commitment to production goals by contracting a fifth drilling rig in September 2025 to compensate for lower-than-expected summer drilling activity, which was partly attributed to adverse weather and facility turnarounds. This disciplined spending supports the company's near-term operational objective of increasing production rates to 140,000 BOE per day by December 2025. The consistent deployment of capital into owned infrastructure provides long-term operational control and reinforces the low-cost operating model. Balance sheet assessment and solvency profile. A rigorous assessment of Peyto's balance sheet reveals a strong asset base and improving leverage metrics, though caution is warranted regarding specific near-term liquidity demands. Leverage profile and strategic debt management. The company's leverage profile was strategically altered in 2023 with the corporate acquisition that significantly expanded its asset base, necessitating an increase in net debt to $1.36 billion. This move, while increasing immediate financial obligations, was a calculated investment designed to enhance scale and increase gas processing capacity by 471 mmcf per day. Management has since prioritized deleveraging, leveraging the robust FFO generation detailed previously. This strategy has yielded measurable results, with net debt reduced by $65.7 million in Q1 2025 and another $39.9 million in Q2 2025, bringing the total reduction for the first half of the year to $105.6 million. The net debt level stood at $1.24 billion at the end of Q 2025. Peyto maintains ample financial flexibility through its $1.05 billion credit facility, ensuring operational liquidity. The long-term solvency of the company is further supported by a significant shareholder equity base of $2.77 billion and total assets valued at nearly $6 billion as of 2023. Working capital components. The Q3 2025 condensed consolidated financial statements reveal the current assets and liabilities, providing a snapshot of the working capital position. Peyto's current assets exhibit solid liquidity. Cash on hand saw a significant rise, reaching $52.078 million, an increase of over $38 million from the prior year. Accounts receivable were reported at $126.709 million. A particularly important component is current derivative financial instruments, representing the fair value of favorable hedges, which stood at $117.193 million. This substantial derivatives balance acts as a tangible near-term asset, providing protection and liquidity against market risk. On the liability side, current obligations include accounts payable and accrued liabilities of $170.15 million and dividends payable totaling $22.209 million. Analysis of near-term debt maturity. The most significant near-term liquidity factor impacting the balance sheet is the sharp increase in the current portion of long-term debt. This figure surged to $149.985 million in Q3 2025 compared to just $57.85 million in the prior year. This material change in the classification of long-term debt indicates that approximately $150 million of principal amortization is due within the next 12 months. The elevated maturity tranche necessitates careful cash flow management. While Peyto's strong free funds flow, FFF, which was $69.1 million in Q3 25 alone, too, suggests the capacity to repay this debt is robust, it implies that FFF generated over the next few quarters must be predominantly dedicated to debt amortization. If this cash flow is successfully directed toward repayment, the company will avoid the need for potentially less favorable refinancing in the current interest rate environment. The successful reduction of this immediate liability is a critical prerequisite for achieving management's objective of reducing net debt and will materially improve the overall leverage metrics heading into the 2026 fiscal year. Dividend safety and shareholder return strategy. Peyto's identity is closely tied to its commitment to sustainable shareholder returns, anchored by a conservative financial philosophy that rigorously ties distributions to generated cash flow. Dividend policy and cash flow alignment. Peyto maintains a predictable and consistent shareholder return schedule, paying a monthly dividend of 0.11 cents per share, 10, which results in a quarterly payout of 0.33 cents per share. The company's financial model explicitly commits to balancing dividends paid to shareholders with corresponding earnings and cash flow, ensuring sustainability rather than chasing high yields during peak commodity cycles. Comprehensive dividend coverage assessment. The financial sustainability of the dividend is evaluated using the total payout ratio, TPR, a non-GAAP measure defined by Peyto as the sum of dividends declared plus total capital expenditures and decommissioning expenditures divided by funds from operations. The TPR ratio directly assesses the percentage of the combined investment and shareholder return demands that are funded by operational cash flow. The most compelling evidence of the company's restored financial health is the significant trajectory of the TPR. The ratio improved decisively from a challenging 125% in Q3 2024 to 99% in Q3 2025. A TPR of 99% is a crucial indicator signifying the achievement of capital self-sufficiency. It confirms that the total financial demands, specifically $126.3 million for capital expenditures, $3.45 million for decommissioning, and $66.4 million for dividends, are completely funded by the $198.9 million generated in operational cash flow, FFO, during the quarter. This material achievement removes the structural reliance on external funding or debt to maintain organic growth and distributions, validating the successful implementation of the company's long-term model. Further confirming safety, a direct analysis of free funds flow, FFF, coverage confirms the dividend is secure. The dividend outlay of $66.4 million in Q3 2025 was covered by the FFF of $69.1 million generated in the same quarter, creating a slight surplus available for debt reduction. On an FFO basis, the dividend is covered approximately 3.0 times, providing a substantial cash flow buffer that protects the distribution against typical fluctuations in operational results or short-term commodity price weakness. Forward dividend security and hedging foundation. The forward safety of the dividend payout is substantially reinforced by the company's proactive risk management. The $655 million in secured revenue for 2026 effectively locks in the necessary cash flow baseline required to maintain the 99% TPR and the current dividend rate. This strategic financial positioning shields the income stream from the anticipated softness in the broader Canadian energy market in 2026. Consequently, Peyto has successfully positioned itself to offer resilient income to shareholders regardless of the near-term volatility affecting unhedged competitors. Valuation analysis and peer benchmarking. Peyto's current valuation suggests a moderate discount relative to its peer group, particularly when considering its historical profitability and structural competitive advantages. The analysis uses standard E&P multiples to assess the company's market pricing. A. Multiples-based valuation. As of November 2025, Peyto traded at a trailing 12-month TTM price-to-earnings ratio of 12.10 times. Although this is slightly above its four-quarter average of 11.15 times, it remains highly competitive within the sector. The enterprise value to EBITDA (EV/EBITDA) multiple, which is less susceptible to accounting treatments like depreciation and financing structure than PE, is reported at 6.05 times. This multiple reflects a reasonable cash flow-based valuation given the company's asset profile. However, the higher enterprise value to free cash flow (EV/FCF) ratio of 19.55 times highlights the company's ongoing capital intensity. This elevated FCF multiple is characteristic of E&P companies, where substantial capital expenditures, such as the $126.3 million spent in Q3 2025, are continuously required to convert long-life resources in the Deep Basin into current producing reserves, a necessary component of sustaining its long reserve life index. Relative value assessment and PE discount. A comparison of PE's key valuation metrics to industry benchmarks suggests a compelling case for relative undervaluation. Peyto's PE ratio of approximately 12 times stands meaningfully below the Canadian oil and gas industry average PE of 14.7 times. This discount is typically observed when the market assigns a penalty for perceived risks, which, in Peyto's case, likely stems from two factors: the inherent volatility associated with natural gas pricing and the elevated net debt carried following the strategic 2023 acquisition. Conversely, the reported EV/EBITDA multiple of 6.05x suggests a closer alignment with general peer averages, estimated near 5.8x9. The opportunity for PE lies in a potential PE re-rating. If the company sustains its rapid FFO growth, 26% YOY in Q3 2025, and successfully manages the upcoming $150 million current debt maturity, the penalty associated with leverage and short-term commodity risk should dissipate. A successful trend of deleveraging, combined with the company's demonstrated operational excellence, highlighted by its industry-leading low cash costs and substantial 10-year proven developed producing reserve life index (RLI10), warrants a market reassessment. A re-rating of the PE multiple from 12.1x toward the industry average of 14.7x, coupled with underlying earnings expansion, would serve to unlock significant shareholder capital appreciation. Analyst consensus and price target. Market analysts currently reflect high conviction and narrow expectations regarding Peyto's near-term valuation. Based on projections from 11 analysts, the 12-month average price target for the company ranges between CA 22.32 and CA 22.91.9. Given the current trading price of approximately CA 21.979, this consensus implies a modest upside potential of approximately 4.27%. The tight spread in analyst targets suggests that Peyto is generally viewed as a predictable, established operator. However, this modest upside potential may fail to fully capture the leverage and profitability that could be realized once the company effectively deploys its spare operational capacity and completes its near-term debt amortization targets. Strategic outlook and external risk landscape. Peyto's long-term value creation is dependent on its ability to leverage internal operational strengths while successfully navigating Canada's evolving regulatory environment and capitalizing on new market dynamics. Operational moat, integrated infrastructure and capacity. Peyto's most robust competitive advantage is derived from its ownership and operation of its core midstream infrastructure. The company controls 17 wholly owned gas processing facilities with a combined gross capacity of 1.5 billion cubic feet per day, BCFD. A key strategic asset added during the acquisition phase was an additional 471 million cubic feet per day, MMCFD, of processing capacity. Crucially, the current utilization rate of this massive infrastructure stands at only 56%. The availability of significant spare capacity means that Peyto can seamlessly increase its production base, targeting 140,000 BOED by the end of the year and substantially beyond, without being forced to allocate major capital expenditures to construct new infrastructure. This structural advantage reduces the company's long-term capital intensity relative to peers who must constantly invest in new processing and gathering facilities. It is a fundamental element that allows PEY to sustain its industry-leading low cash costs of approximately $1.31 per MCFE3 and compete aggressively in the Deep Basin against major integrated competitors. Emerging growth vectors and market diversification. While forecasts predict a general slowdown in Canadian capital spending in 2026, Peyto is uniquely positioned to benefit from new market dynamics and existing infrastructure access. The company's assets are strategically located near major natural gas egress points, including the NGTL and Alliance pipelines, facilitating competitive access to various North American markets. A significant emerging domestic demand vector is the rapidly growing need for reliable 24-hour power generation, especially from the expanding AI and hyperscale data center industry in Alberta. Natural gas serves as a crucial power source in this context. Peyto's extensive Deep Basin land holdings and owned gas processing capacity positions it perfectly to service this stable, high-value demand. This emerging market opportunity provides necessary diversification, reducing the company's reliance solely on the often volatile export or AECO benchmark pricing environments. Conclusion. Peyto Exploration and Development Corp distinguishes itself through a rigorous business model centered on operational efficiency, financial balance, and long-life assets. The analytical findings confirm the core strength and sustainability of its financial performance. The income statement demonstrates robust earnings expansion, buttressed by structurally low cash costs and effective hedging that provides stability against market cycles. The Q3 2025 results underscore the success of management's post-acquisition integration efforts. The critical assessment of the cash flow statement validates the financial model's effectiveness. The total payout ratio's recovery to 99% in Q3 2025 confirms that the company is currently operating on a self-funding basis. This means organic growth and all shareholder distributions are covered by internal funds from operations, eliminating the dependence on external capital. This fundamental shift is paramount for long-term value creation. Furthermore, the dividend safety is confirmed by the positive surplus generated in free funds flow, which is further secured by proactive revenue hedging into 2026. The balance sheet, while generally healthy and deleveraging on a long-term basis, presents a focused near-term requirement: the management of the approximately $150 million current portion of long-term debt. Successful amortization of this liability using consistent free funds flow will unlock substantial improvement in the company's overall leverage profile. From a valuation perspective, Peyto currently trades at a discernible discount relative to its Canadian E&P peers on a PE basis. This discount is inconsistent with the company's structural operational moat derived from its owned processing facilities, industry-leading low costs, and guaranteed access to major pipelines. The company possesses clear catalysts for multiple expansion, driven by continuous debt reduction and leveraging its significant spare processing capacity for efficient, low-capital production growth. The analysis supports the view that Peyto is positioned defensively for macro headwinds while retaining significant operational upside, therefore signaling that Peyto offers a compelling balance of secure income, financial resilience, and opportunity for capital appreciation through PE re-rating. Investors are expected to benefit from the disciplined application of free funds flow toward deleveraging and the consistent returns derived from its exceptional deep basin asset base.